Warren Buffett's Guide, the simplest way to grow a small investment account. Hey everyone, welcome back to the channel. If you've ever wondered how to grow your money the Warren Buffett way, even if you're starting with just a small account, you're in the right place. In today's video, we're diving into the simplest way to grow your account inspired by the Oracle of Omaha himself. We'll uncover the secrets and strategies that Buffett used during his early years and how you can apply these principles to boost your own investments. Stay tuned, because you won't want to miss these invaluable insights that could potentially transform your financial future. Let's get started. Buffett's early investment journey. So, let's turn the clock back to 1951. This was the beginning of Warren Buffett's investment career, a period that stretched up to 1969. During these years, Buffett wasn't just playing the game, he was rewriting the rules. How so? Well, he bagged an annual return of around 29%. His early strategy? Pretty straightforward. Find undervalued stocks, buy them cheap, and sell them as soon as a profit was on the horizon. But here's where it gets interesting. As Buffett's funds grew, he couldn't just play hit and run with stocks anymore. He needed a new game plan. So he shifted gears towards buying companies that weren't just undervalued, but also had solid long-term economic prospects. This wasn't just about quick cash, it was about sustainable growth. Buffett's investment philosophy for managing small sums. Fast forward to today, and let's imagine Buffett managing a small sum of money. His approach remains consistent with his refined investment philosophy. Pinpoint businesses that are priced low relative to what they'll be worth in the future. This is the simplest way to grow your account. It sounds simple, right? But it's all about seeing the potential that others might miss. Managing smaller sums comes with its perks. For starters, you have access to a ton of investment opportunities that big investors might ignore because, frankly, they just don't move the needle for them. Reflecting on his most lucrative years, right after he met his mentor Ben Graham, in the early 1950s, Buffett was hitting annual returns of about 50%. Yep, you heard that right, 50%. During those days, he spent a ton of time analyzing businesses, focusing particularly on those that were massively undervalued. The smaller scale of his investments back then allowed for these huge returns, something that gets tougher to replicate with bigger sums. The strategy of obscure stocks. Warren Buffett's longtime business partner Charlie Munger has often highlighted the benefits of looking into obscure stocks. These are stocks that haven't caught the market's eye yet, but are undervalued treasures waiting to be discovered. This approach isn't about following the herd. It's about leading it by finding opportunities that are significantly mispriced. Historically, Buffett himself often zeroed in on just one or two stocks that showed massive potential for quick growth. This laser-focused strategy led to hefty returns when Buffett's funds were still in their relative infancy. While this strategy might be a no-go for managing vast funds like today's Berkshire Hathaway, for small investors, it's still golden. Why small-scale investors have the edge today. Now, if you're a small-scale investor today, you actually have a strategic advantage over the big players like Buffett. Why? Because you can operate under the radar across a broad spectrum of investment opportunities. This flexibility is your secret weapon. Investing in smaller companies is particularly exciting. These businesses often have a much higher growth potential than the established giants. Take, for example, Boyd Group Services. Over 2 decades, Boyd dramatically grew its cash flows. This kind of rapid expansion is more attainable in the realm of smaller companies and is exactly where you, as a small-scale investor, can shine. Applying Warren Buffett's investment strategies. Now let's break down Buffett's investment methodologies and adapt them for individuals who wants to grow their smaller accounts. 1. Understanding the value of undervalued stocks. Start by researching industries and companies that are currently undervalued in the market. Utilize financial metrics such as PE ratio, PB ratio, and debt-to-equity ratio to gauge the intrinsic value of these companies. Emulate Buffett's early investment approach by investing in multiple undervalued stocks without heavy regard for their long-term prospects. This method works well when starting with a small sum and looking to grow capital through quick, short-term gains. 2. Switch to quality as capital grows. As your portfolio grows, gradually shift your focus towards companies with strong long-term economic prospects and sustainable competitive advantages. Mimic Buffett's transition by investing in fewer, high-quality companies that offer more assurance and stability over time. 3. Focus on future cash flows. Learn to perform discounted cash flow (DCF) analysis to estimate the value of an investment based on its future cash flows. This method aligns with Buffett's philosophy of valuing a business based on the cash it can generate in the future, rather than its current market price. Use this analysis to decide whether a stock is undervalued and if it aligns with your long-term investment goals. 4. Exploit the advantage of small sums. Leverage the flexibility of managing a smaller portfolio by exploring investment opportunities in small to mid-sized companies that are often ignored by larger investors. Target companies that have the potential for rapid growth. 5. Utilize obscurity. Follow Charlie Munger's advice to seek out stocks that are not well known or popular among the majority of investors. These stocks often present mispriced opportunities due to their lack of visibility. Dedicate time to researching lesser-known industries or companies that may not be covered extensively by mainstream financial analysts. 6. Monitor and adjust. Regularly review your portfolio to ensure that your investments are performing as expected and adjust your strategy as needed. Keep up to date with market trends and economic factors that could affect your investments, adjusting your strategies to mitigate risks and capitalize on new opportunities. Thank you so much for sticking with us until the end of this video. I hope you found our deep dive into Warren Buffett's strategies for growing a small investment account both informative and inspiring. Remember, it's not about the size of your capital, but the strategy behind your investments that truly counts. If you enjoyed today's content and found it useful, please consider giving us a like. It really helps the channel. And if you have any questions or would like to share your own experiences with small-scale investing, don't hesitate to drop a comment below. We love hearing from you, and your insights could help other viewers on their investment journeys. Don't forget to subscribe if you haven't already. Also, hit that notification bell so you never miss out on our latest uploads. Thank you again for watching. Keep investing smart, stay patient, and I'll see you in the next video. Remember, your journey to financial freedom is just a few smart decisions away. Take care, everyone.